Hello, everybody. My name is Rick Malero, and I'm a real estate investor based out of Orlando, Florida. I've been investing in real estate now for over 15 years, and I've had the privilege and honor of working with many, many investors across the nation and some around the globe. We've had such a great opportunity of investing in both residential, commercial, and one of my favorite strategies, which I'm going to talk about today, which is whole note investing, which has been one of our really incredible strategies that have really empowered us to become the bank. And today in this case study, I want to share with you an example of a day-to-day ordinary person who leveraged our business model to generate passive returns secured by real estate investments, literally emulating the bank strategy. So again, I'm not going to talk too much about myself right now, but over time, you'll see more information about us and you'll see how long we've been in the industry, our track record, and I hope that that speaks for itself. But today, the very first thing that I want to do as we dive into this particular case study is I really want to explain to you and show you what the difference is between being an active investor and a passive investor. And I really believe that some of us need to do a combination of the two, but ultimately every single investor should be aiming to become a passive investor that makes their money work for them so they don't have to. Now, the first thing I want us to do is to really develop the thinking, the mindset that is tied specifically to being an investor. And it really begins with understanding your life within the time span. And I think it's critical for us to understand that if you want to be a successful investor and you want to leave a legacy, you have to first face reality. And what do I mean by that? That means that, hey, there's an industry right now making millions and millions of dollars a month selling people courses on how to hustle and grind and work your butt off to make money. And to a degree, that's imperative. You have to do that to start developing resources, because if you don't produce, you don't have anything to invest. However, this is where people fail. They tell you that it's all about the hustle and grind, but what they fail to tell you is that over time, you physically cannot keep up with the young version of yourself. Because as we get older, we lose that energy. We lose the ability to be able to hustle and grind 100 hours a week, every single week. I don't know about you, and I don't know how old you are, but I can tell you that I still cannot perform in running the way that I did when I was 18. It's just the way it is. Over time, some of that energy diminishes. And so then you have to really start thinking smart. So what I want you to do is look at this for just a second with me. As an investor, it is imperative for us to leverage, while we're younger, that energy that we have, that hustle and grind, and we use our mind to start then saving that money, investing it passively, so that over time, that passive income begins to exceed our physical capabilities. And to be honest with you, when it's time to go, if you've done it right, you're able to leave a legacy to your family, an inheritance of passive income streams. And I really believe that every single investor should have this mentality about investing. It is good to grind, it is good to hustle, but at the end of the day, it is very important to begin to put passive investing into the equation so that it builds success. Now let me introduce you to a business model that we kind of stumbled into. So this is what I call our active investing. When I first started in the industry, I was buying, fixing, and flipping homes. I was buying, fixing, and holding, and I had a variety of strategies. In fact, in just one of the markets, I was looking at the numbers the other day, in just one of the markets, we purchased around 400 properties over the course of 2.5 years. And it was a lot of money that we made, but to be honest with you, it was a lot of work. I mean, every single day dealing with contractor issues, having problems with delays. In fact, we got to a point, because we're buying over 10 properties a month, we got to a point in our investment strategy that if I bought a house today, it would literally sometimes take 60 to 90 days before my crew can get to that house. And it really started having a negative impact on the business, and it started impacting our finances. And I share this with you because, hey, it was great. We made a lot of money, but it was a lot of work. And so it was during this time that we began to reassess the business and said, man, being active is good when you do it with a smaller percentage of work. But if we're going to scale, there has to be a way that we can scale passively. And that's when the first idea popped in. I started thinking, wait a minute, what do the banks do? They're doing billions of dollars, some of them on a monthly basis. How is it possible that they can scale to that level and generate this passive income? And so as I started studying the banks, I realized that their strategy was very effective. They were able to lend money out to investors. They're able to collect interest payments on a monthly basis without having to worry about the headaches of contractor, utilities, property taxes, landlord headaches, you name it. They didn't have to deal with that, but they got paid every month, rain or shine. And what was the collateral? Well, the collateral obviously was the property. And so I thought that this was a really good business model. So we decided in 2013 to do a test model where we would allocate about $2 million of our capital into this particular business strategy. Now, fast forward to that whole year, we ended up deploying over $6 million. And I realized, man, there's a lot of demand. There's a lot of good people that are doing good business that need this kind of capital. And so that's when we decided to take it seriously. So then his capital went out and we raised some capital from other partners that we had, and we did over $35 million specifically to do this model. So let me kind of give you how the active side worked. So what we would do is we would connect with, network with, and by word of mouth, get relationships established with active investors. These are people that were doing maybe 2 to 3 deals a month. They had experience, they were doing deals, and we told them that we had this capital available for them that would be much faster and much more flexible than what they can get at a Wells Fargo bank. And so these clients will then submit an application to our team. Our team would make sure that we have all of the basic paperwork that we need to start our due diligence. From there, that file was sent over to the processing team, which by the way is in my office. My processor would then make sure we ordered title, insurance, that we made sure that the comparable sales were there. We ordered the third-party valuation and a variety of things that needed to be done in order to make sure that the file was in order so that then we can send it over to our underwriting team. Now, our underwriting team is at a little bit higher level of experience in that their job is to really put the brakes on a deal. Their job is to make sure, do we have a win-win? If we lend this investor money, do we win? Do they win? Is the opportunity there? If they say that the answer there is no win-win, then that's basically when we put the brakes on this transaction. We say, listen, send it back to the borrower, tell them these are our concerns, and either we mitigate the risk or we don't do the deal at all. Now, if the deal does make sense and the borrower does make sense and that they fit our tight parameter of criteria, then we go into the next stage, which is funding. In this moment is when we send the legal documents to the title company, we send the wire, the mortgage is recorded, and ultimately what we started doing was, instead of doing all the work ourselves of servicing these loans, we hired a third-party company that would collect the payments directly from the borrower and pay us every month. So this was the initial model, and it was really, really good. And with $35 million, I thought, well, hey, guess what? That's all we need right now. And funny enough, as we started lending money and we started connecting with investors that were experienced, what we realized is that the average investor that had experience was borrowing from us 4 times a year at least. And so this created a major demand for us to be able to come up with more money. Now, lo and behold, over time, I would say about 1.5 years into this, we started getting phone calls from other private hedge funds saying, hey, I really like your business model. How do we partner with you? And after looking at their terms and conditions, we just didn't feel comfortable with partnering with them. So what we started doing is saying, well, listen, I would consider selling some of my portfolio of existing performing notes. And if you were send me the money back on the money that we've invested, then we can do a partnership on the interest rate. And so that's where the first relationship began. We had a big investor come in, and I call these investors passive investors, who actually bought a note from us that was performing and paying every single month. Now they collect the payment, of course, directly from the servicer, and that would happen every single month. And of course, when the investor would sell or refinance a property and there was a payoff, the servicer would send them the money automatically to their account. And then, of course, the majority of them would reinvest their capital. So this is what kind of created this infinity model that was incredible, because number one, as a lender, I have to scale the business. I have to have a lot of money available to fund these investors. So now with this partnership of institutions, we now have this liquidity to be able to do the investments that we need to. And when we need more liquidity, we sell off some of these mortgages to our hedge funds, which was a great model. And then I started getting phone calls from investors that were just individual investors looking for a place to put their money. And we connected with a few investors. In fact, the case study that I'm going to talk about today, now that I've kind of led up to this particular strategy, was very specific, because they started reaching out to us saying, hey, we want to find a way that we can invest and get a solid return on our investment without doing all the active work. How can we get involved? And so having that system in place and working with investors that were already buying by the dozens from us, we started building a model that allowed investors that were ordinary investors to buy 1 or 2 or 3 loans a year if they wanted, and allow that passive income to go into their pocket. Now, to date, if you fast forward to 2019, going on 2020, we have had the privilege of serving over 1,879 investors in over 49 states through a host of partnerships that we have with investors. And to give you perspective, up until March of 2019, one of our biggest note buyers had purchased over $30,809,656.45. So I say that to you to say that there are a lot of investors, even at a bigger scale, that are raising money, pooling money together in their offerings and their funds to invest money in investments like the ones that we're putting together. In the same vein, we're dealing with individual investors that will buy 1 or 2 or 3 loans a year. And so what this model created was really an opportunity to serve the active investor and also the passive investor looking to create a return as we scale the business. So with that said, let me dive in a little bit deeper about this particular file. This is a case study on a very small deal that we did with a client that has worked with us various times in the past. And I want to break this case study down briefly so that you get a picture of what we do. So now, as a lender, we have tools and technology that we've developed. These are processes that are critical for us to protect our investors and to protect ourselves when we make these decisions. You see, we can't be emotional about a deal. And just because a client tells me it's a good deal doesn't mean that it is. So what we've actually done is we develop processes and protocols that allow us to break down all of the key things that we have to analyze in a deal when we're looking to invest. Now, our diligence process is really boiling down to focus on specifically project analysis. We want to know, does this deal make sense? Is this deal a win-win? Once a deal makes sense, we start diving into the character of the borrower. So then we start asking questions in our due diligence process of, is this the right borrower for the deal? Does this client have the experience that is tied to that type of investment? Is their background clean? Are we going to have to deal with issues with character flaws? Those are the things that we want to know, is what does the credit look like? What does the history look like? What does their experience look like? And if we feel comfortable that this is a person that we can trust, then we move forward. The next aspect of our business, of course, is making sure that the title on the property we're going to finance is correct, that there aren't any liens on the property, that we don't have any potential issues to worry about, and that we have the proper title coverage to make sure that if something did go wrong, we can get covered on the insurance policy to protect our investment. We do the same thing with hazard insurance and a variety of things, which again, in a minute here, I'll dive into. Now, the reason why I want to talk about these things is because when this particular client came to us, even though as you can see on the screen, this was a very small $55,000, $500 loan. Okay. Now this investment, even though it's a smaller loan in comparison to some of our $1 million properties, it literally still has to go through the rigorous process so that we can make sure we feel comfortable with this particular transaction, the borrower, the title, and the insurance and so forth. And so this client, obviously, he met our guidelines because we worked with him in the past. He had a clean background. He has experience in this kind of deal. He's performed in the past. And because of that relationship, we were able to dive into this deal and see that it made sense. It truly was a win-win. We were able to look at our protocols and we made sure that our vetting process was in place for this deal. Now, to give you perspective, here's the picture of the client. This is the actual active investor. We did a full valuation on the property. And the point I'm trying to make here, guys, is take a look at the screen here. For a project of only $55,000, we literally collected over 53 documents in our due diligence process. From breaking down legal documents, breaking down our due diligence documentation, our comparable sales, our renovation scope of work, our comparable analysis, our market analysis, title reports, you name it. Every deal, regardless of whether it's $55,000 or $1 million, has to undergo a due diligence process. Now, this is where most individual smaller investors struggle because they don't have the bandwidth, nor do they have the experience to really vet these things. And so the benefit of working with a company like us is that we have those processes in place. We do our due diligence and we make sure that we cross those T's and dot our I's when we're doing our diligence, because we want to make sure that our clients continue to purchase mortgages from us. And in order for them to do that, they have to have a much bigger success rate of performance with the borrowers. And so again, I want to show you that after the whole process, we literally had over 53 documents collected in our system, in our stored files, that were secured specifically in this property. Once we had approved the deal and we were ready to fund it, here are the basic numbers. So as the lender, he's done several deals with us. We're funding him on this transaction at $55,000. We're at 53 cents on the dollar. Literally 53.19% is officially our loan to value on this deal. That means that the total amount of equity on the property in the event that this borrower defaulted would be $48,845 in equity. Now, why is this important? It's important because even though we want to make sure it's a win-win, we want to make sure that our borrower that's an active investor is making money. We also want to make sure that in the event that he were to go in default, that we would have enough equity in this property to pay for our legal costs that our company pays, to finish the foreclosure, and ultimately resell the property or rent it so that we can generate a profit for us and our investors. And so it's imperative when we fund our investments that we have as low loan to value as possible. And so this is just showing you an example of a loan that is 12 months long, that specifically the client is buying to fix and ultimately refinance as he rents it out to another third-party tenant. And so I wanted you to see this because this client had bought an incredible property at a great price. He was able to fix it up, get it leased up, to then work on refinancing for a longer-term loan now that the property was stabilized. This is the very reason why he needed funding from us, because most banks will not finance a property that's in distress. They will only finance it once it's stabilized and producing income. So this is where the bridge capital becomes such a great opportunity. And this is why these investors are willing to pay a higher interest rate to a guy like me, which is what creates an opportunity for our whole loan investors. So now let me bring you to the investor. So in this particular case, after we funded the deal, the borrower is now paying through FCI and we're collecting our interest payments. We had a client, Danielle. Danielle is an ordinary person who is saving money, and her goal long-term, as she listens to her father, is to learn how to invest passively. She learned about our business. She fell in love with our due diligence process. And so therefore, she decided that she wanted to purchase and own a whole note directly from us. So what's beautiful about a whole note investment is this: even though his capital funding funded the transaction, we are now the owner of the mortgage, the borrower owes us the money. When an investor wants to participate, we're able to sell off that mortgage. So now Danielle, who you see in this picture, as a passive investor, is the 100% owner of this new mortgage where the borrower is paying every single month. In this case, we're charging the investor a 10% interest rate. We're collecting 2% for his capital funding since we originated, funded, and sold the mortgage. And Danielle gets to sit back, collect 8%, literally doing nothing, hanging out with their family. And little by little, that income comes in every single month, helping her to build this passive income. So this is a perfect example of an everyday person who leveraged our business to become the bank. And she used her money to become the bank and generate cash flow every month without having to deal with the headaches of ownership or taxes or all the issues that come with being an active investor. That's the reason why this is a perfect match. You see, we look for active investors that are doing this full time, that need the funding to grow and continue to scale their business. And we offer these opportunities to passive investors who want to invest, but they don't have the time to manage those investments actively. And so this is a perfect example of a client who's an everyday investor who's looking to let their money work for them so they don't have to. So the document you see here is what we call a loan purchase certificate. So this is an agreement that we've executed with her that stipulates all the ownership rights that she has. We then do what is called an assignment of mortgage, which is what you're looking at on the screen. Now, why is this document so important? Because this is the document that transfers the full ownership of the loan from Rick Malero, the company for his capital, directly to the investor when they buy the mortgage. And this is recorded in public records so that in the event that, God forbid, I die, or God forbid, we were in a lawsuit or something happened to our business, the investor still owns 100% of that mortgage. So what happens to me is irrelevant at this point. They are protected and they are the rightful owner of this mortgage. And that's what makes this investment so solid, is that you know where your money is. And again, this is the instrument that ultimately assigns those rights to the investor. Now, this is when it goes into our actual servicing. So what you're looking at on the screen right now is a report of this particular borrower. This borrower has made monthly payments to us every single month. And what we're able to do by leveraging a third-party company that is really good at what they do is they collect the payments directly from the borrower. They do all the accounting tracking for us. They pay us and they pay our investor every single month in ACH, so that Danielle doesn't have to worry about those payments coming in, and his capital doesn't have to worry about those payments coming in. Those payments automatically come into our accounts. Now, this reporting allows us to see where we stand on the loan at any given time. And that's the benefit of working with this organization that does all the servicing for us. So we're able to pull these reports so that we know exactly what has been paid, what has not been paid, what is pending. And of course, Danielle gets those reports as well. She gets to see those payments from the actual borrower coming every single month and showing those reports of those payments that are coming in. And so what's amazing about this is that the investor is truly passive. They're just getting a report, hey, you got paid. And in the event of a default, because again, we're at 53.19 cents on the dollar, Danielle has a substantial amount of equity in that investment that she can collect. And in that case, our post-closing team within our office coordinates with the servicer, and we communicate with the borrower to try to restore the loan, which the benefit right now is over the last 3 years, we've only had 4 foreclosures out of doing millions and millions of dollars on a monthly basis in capital deployment. The reason why I share this with you is because, again, being partnered with a lender servicing company that knows investments is really helpful, because it helps us to identify when there's a trend. Our due diligence process is what really secures us, which is why we have such a small default rate. And this, again, just gives the whole note investor the ability to invest with confidence, knowing that there is a third-party company collecting those payments and keeping us abreast of what's going on with that investment every single month, taking care of all the accounting and all the reporting that have to be provided. And those are one of the amazing benefits of actually doing that. Guys, this is a really powerful quote that I teach our team on a regular basis. We talk about going far, and I really believe that a whole note investor working in partnership with an actual investor like myself can really achieve so much more. And it's perfect. It goes just with this quote that says, if you want to go fast, you go alone. But if you want to go far, you go together. And what we've built here, guys, is a business model that allows investors to go far with us. They leverage our resources and they're able to invest in whole notes, allowing the cash flow to start building up on their side without them having to do the work, which frees us up to continue to grow our business and to offer funding products to other active investors that are also winning. Guys, this is what I call going far and creating a win-win for every party involved. If you think about it, the active investor gets to win because he's making the profit. We get to win because we're deploying capital and we're scaling our business and getting a percentage of the interest. And our whole note investor gets to win because they can truly be a passive investor collecting payments every single month passively.